Good morning, time 10:01 a.m. Pacific Standard Time. It's a very special day on 3/1, March 1st of 2014. Now, what I have once again, MMTs and our traders around the world, is this S&P index. And from the very lows that occurred over here was March of '09. 3/1 of 2009, March. Now, here we are. Here is 1 year in 2009. Then once again, here is the second year, 2011, a nice correction. And then 2012, and we had a small correction, and they came right back in. So 2012 was a very volatile period of time for both the bull and the bear, as we know. But then again, let's just take a look at this big move here in 2013. And now the January and February have completed their bull and bear cycle. What I can say beyond a reasonable doubt, there is no doubt, is that mathematically we have hit a 5-year or 60-month cycle between the bear and the bull. So when the bear started back over here in year 2000, we went straight down until, once again, just listen to me carefully. This bottom here was exactly 3/1. Once again, March 1, 3/1. We went straight up in that expansion. Bush was in office. Paulson was in there. But then when we got up to the top here in 10/1 of 2007, we started off right here with a reversal in November of 2007, when historically that's the best time to be in equities. That wasn't the case. What the case was, though, was we went from the high of that S&P at 1576 clear down to this bottom of 3/1 of 2009. And yes, the low of the S&P was 666.79. Now, the 60-month expansion, 1, 2, and 3, and 4, and the 5th year is actually the anniversary between the bull and the bear, with the longer term bear being in control. But we can see that the bull, from that bottom up, from this expansion, has gone greater in value than any other time. It's all right here. So it's all going to start over on March 1, which will be Monday. Like I said, today is 3/1. It's a very special time for a lot of people. However, people need to be aware that we told everyone before the market opened up in January of 2014 to expect a bigger, much bigger volatility ranges in all of the indexes. We have not had a meaningful 10% correction. You would have to go back over here in year 2011 when we had that correction, and now we have gone parabolically up. And there are a lot of things that they have done to create this move, using supercomputers that buy and sell equities and just re-leverage the assets up. So basically, on this monthly chart, I'm going to put a trend line right about there. And that was the peak of the reversal in 2000. It started, made a high in 2007. Then in 2008, they went all the way down in the financial crisis. That's ultimately going to be that support level. Let's be very clear. The other thing that we're going to tell people, and we have not been wrong, is that I'm going to point out how January started out. January 1/1 of 2014 had an open of 1845.86. And then in the monthly high, we went as high as 1850.84. That was the high. Then, when February of 2014, we hit on the very first trading day, the S&P came right down to this blue line, which is roughly in line with the 10-month moving average for the bull. We can see right here that we closed slightly up on Friday in the S&P right here was 1859.45. We also told people our short-term target on the S&P was 1865 to an 1870 level. We have completed it now. And I will tell everybody that you will remember this day. You will remember this day as we go forward into the 10-month range that is left in the S&P before the 2015 period will be in play. Now, one of the things that we'll be very happy to say about this special event, the special event is how 60-month time series cycles work. Our economy, our workforce, Obamacare, oh yes, there's a lot of things. Now you have the Russian government with the big catastrophes that's going on there. Friday, we sold down pretty good. And so we are going to close out February at the high was 1867. That was 2 points above our target. And now that was the high for February. And we closed out at 1859. I'm going to draw a trend line for my MMTs. And remember, we've called lots of bottoms and lots of things. Listen, this bull has a lot behind it. It's got a lot of leg in here now. However, when the bull gets a 60-month run, this is where the price volatility becomes a much wider range for both the bull and the bear. And within that price volatility, month after month in the seasonalities that we will go through, spring is not far away. Everyone's going to be expecting, historically, a spring rally. Well, I am sorry for the bull because the spring rally has already priced in that 1867 on the S&P. That means it's limited. The upside from here in this time series is limited. And once again, when we go back over to this calendar part, this was the big breakout month on 10/1 of 2013 that got us to that very special time in December. Christmas, the New Year started here. However, it's very important to see who has the most leg right now. The bull has gotten a bigger upside versus the bear downside. Now, having said that, I'm going to tell you this is where the monthly consolidations on a monthly level was doing their thing. And every time we had a pullback, it was a buy. Every time we had a pullback, it was a buy. However, this big bull money, the big people, they have already made the move. Yeah, they started back over here. I'm going to show you, as soon as I can just get this part of the chart, I'm going to show you. The biggest money was already made, like all expansion models or multiples are going higher. Look at, I'm going to say one thing. You better be careful because it's going to be strong volatility. Not only that, I'm going to show you how overbought the bull is. But the more overbought the bull, the stronger the bull is. Just like when we were in the bear cycles, the more that the bear had the move, then of course that they were very strong, the bears. Now the bear is very, very weak. Just because we had the pullback, listen, we had a greater upside. Okay? Now, March is going to be 12, 24, 36, 48, and 60 months looking forward. So if you take the next 5 years from 2014 to 5 years going out, that's going to bring us into 2019. Listen, there's going to be such a rocky road in this next 60 months that most people will not even know what hit them or how to handle what is going to hit them. And that means that when markets get extremely overbought with no fear and everybody thinks the world is good, because that financial crisis that happened in 2008 is still there. And that tremendous deleveraging process that we went through was more than what all of your financial institutions could handle. And this is the very truth of the nature. One thing that we can say for sure, the math will not lie. And that, my friends, is the truth. And the only truth that you will ever have. Because everybody can talk about what's going to happen. We will say that is speculation. And it is. When the math starts to change, then that is where the cycles change in price volatility in the overall movement in a yearly, compounded yearly, going back many years on the S&P, starting at 1950. Yes, you heard what I said, 1950. And we have the open, the high, the low, the close, and the volume for each one of those calendar years from 1950 to, well, currently to 2014. And along the way, there's been plenty of bear moves and bull moves. Now, generally, the majority of the crowd are always going to come into the market at a late period in time when they should have been buying back in 2009, 10, and buying the dips in 2011. They didn't. That means a lot of the people don't start getting in until 5 years later. You know, it's very unfortunate that in the last crisis that we had, that the individual people had to pay a horrendous price. And it really changed people's lives. And a lot of the foreclosures and people losing their homes. And, you know, since then, the United States government has put in a tremendous amount of what we call financial injections into the system with all of the QEs. Now, one thing about the bear side is that that bear move that will start, it will start gradually and incrementally. So you have a lot more support in this 60-month process that starts over today. And it does. The first day of March. And what's ironic now, here's what I'm going to say. Here's where we have the corrections. And believe it or not, now just listen to me carefully. This correction that started over here was on 8/1 of year 2000. But when we get back over here at the top, this was a top. And what was that top? March 1. Once again, it was March 1 when we peaked to the high over here on March 1 of 1,552.87. And that the low was 1346 and the close was 1498. It all started in that March period. And then when we got down here, we made that bottom in October and we rallied up. And, you know, it was March 1. Again, March 1 of that new expansion multiple cycle that took place with steroids by the government. This was Alan Greenspan and Mr. Bush administration in the White House. And we started that big rally on March 1. Yeah. And what year was it? It was 2003. How about that? Iraq war, everything went all the way up. All the way up to the very top when the housing market destroyed America. Exuberance. And we will just let you know that the bigger side of that move right here, You can see it right here. That was 1/1 of 2008. January effect was down big. It's very key for you to understand how January started out. It started out very volatile and to the downside until America was on their deathbed and corporations were about to go bankrupt across the globe. Now, what's ironic is that this is 3/1. Again, listen to me carefully. March 1. Listen to me. March 1 of 2009. It starts all over again, as it does. And not only that, my friends, I'm going to just blow up this portion of last year's rally. I'm going to put this down here and I'm going to go to last year, January. We already know what the other January was. Now, mathematically, this January right here is 2014. Now, ironically enough, listen to me carefully, the low was 1737, and the high of this move, the bull, got to 1867. And not only that, that was our price. Yes, it was. Just remember, the math doesn't lie. In our system, at 1782, the bull is not in control and the bear is not in control. So that is the neutral point. When we went down slightly below 1/2 delta, just a few, it was 1737, we went from 1/2 delta, and at this point, and this is a yearly formula, it will never change for the year. And it's always accurate. We have them for multiple years. So 1782 is where the bull and the bear cross each other's path. Now we hit my target. It went right up here to 1867. I said 1865. That is one full delta up. 1.00 ratio equals mathematically 80.39 from the 1782 area, which equals a positive 4.51%. That the bull, once again, is at the top. Now, when they were down here at the negative half delta, which was 0.50 ratio, that was only a haircut in our system, and this system never lies. That was minus 2.25%, or 40.19 handles below that particular area. So having said that, we are going up in this delta tree, but we're going to have more corrections. Now, everybody will be expecting a January spring rally. Well, I'm sorry. The spring rally has already started, and it started at the bottom of 1730 up to 1867. That rally has already taken place with the 10-month moving average, which is a simple one, and this is that effect. There are 10 months left in this move. The volatility will be extremely higher, as it is after it is when you have this big of a move in any yearly cycle, in a 12-month cycle. Listen, we called a couple of pullbacks, and we started out with the great short here and then buying the calls. The bull is still in here, and it will remain in here. The only thing is, though, the bull will come fighting back. They're the ones that have the most support right now. But it all starts over in January of 14, going out in the next 60-month cycle. All right. All right, hold on. All right. Hold on. Okay. Here, I'm sorry I wasn't on mute there because I was drawing trend lines for the MMTs. I had one teletyping me asking a question. So we want to just point out, this is the overall daily chart of the S&P. And that spring rally is very limited. Everyone's going to be anticipating that, but I can tell you the way that January started out, here's our lows, and here's the counter rally. on a daily chart. Now, this looks like it would be extremely bullish. However, the chart is very deceptive when people are going to be looking at it. That means one thing. Everybody is going to be on that bull side. What's going to end up happening is that when we started this rectangular consolidation through this period, and then we went totally straight down, as we did. And not only that, that the longer term trend here we have a special 5-year weekly movement on the S&P. And what I'm going to be happy to do is I'm going to draw a trend line. What we are going to do is we're going to leave this particular video at the weekly chart. So stay tuned. We will be adding the weekly in the next series. So it'll be part 1 and part 2. Part 1 was on the monthly level and the daily level that we showed, but this weekly chart is really going to tell you what it tells me I'm going to tell you. So stay tuned and go there on the next live video for all our traders around the world in the current MMTs.